Welcome back to Switzer on Australia's Business Channel. Reporting season can often bring about different interpretation of what's going on in corporate Australia. So let's see what a former stockbroker of the year and former boss of CommSec, Paul Rickard, is seeing in the myriad of reports we've seen so far. Paul, thanks for joining us.
Thanks, Peter. Great to be here.
Now, one of the interesting parts of the reporting season was this extraordinary offer for Toll from Japan Post. And we have a viewer question on this. Let me just read this out to you. It's quite a logical question as well. And I think it comes from Peter. I can't understand why the ASX market price of Toll was nearly 50% below the Japanese takeover price. How can this be the case in terms of investor share value of the stock? So he's basically saying the market was way off. What's the story there, Paul?
Well, markets often get things wrong, and I think let's just go back and relive history a little bit. I mean, Toll was about a $23 company back in 2007. For the last couple of years, it's largely been trading between $5 and $6. It's been a little bit higher at times, but you know, it's been doing it fairly tough. It's got a really strong core franchise throughout Australia and parts of Asia. But the market had been underwhelming a little bit on in terms of its earnings. So
you can see, Paul, it was going nowhere until Japan Post.
It was definitely going nowhere as far as anyone in Australia was concerned. Earnings growth was really low single digit. And they've gone through a bit of cost cutting. So, look, the market had it on a PE of about 14 to 1. And by Australian market ratios, that's below average, but not massively below average. A nice sort of steady dividend, but not really much glamour and sort of a bit on the neglected side, as that chart tells you.
Has Japan paid over the odds, do you think?
Well, look, for a couple of things. First of all, their market trades at a different multiple to the Australian market. So what a company in Japan can afford is different to what an Australian company. We find that across all markets. Interest rates are lower, growth rates is different, all sorts of reasons why it might be more attractive. But secondly, to make it attractive to shareholders, you need to pay about a 50% premium, 40 to 50% premium, which is what they're paying. So, you know, all the people like you and I and those people that might have owned at a lot higher prices to want to accept. And again, what are they going to do with it? They're going to incorporate it into their business. They're going to use it as a springboard for growth across Asia. You know, their traditional postal business is facing a number of challenges. They've got a small logistics division. So from where Japan Post is sitting, it's worth a lot more to them than arguably it is as a separately listed company in Australia. I think shareholders are doing fantastically well.
Maybe Australia Post should have bought it at maybe $8 or something.
I think Australia Post is actually going to report a loss, is what they're suggesting. But look, I think it's a great business, but it's probably a lot more value to someone in Japan Post who can use it across Asia than perhaps by itself. So,
okay, given the fact it was 23 and it sort of went sideways around the $5 and $6 mark for quite a long time, why did you put it in your portfolio? Because Paul put together a portfolio. One was a dividend one and one was a growth one for Switzer Super Report. Why did you have Toll in that?
A couple of things. One, I thought it was cheap because the PE was below market. And I said it was trading around a PE of around about 14 before Japan Post had paid a PE of about 21 for it. Secondly, it did have a reasonable dividend yield. And thirdly, although the earnings growth wasn't doing a lot, it was a little bit there, and I've got a bit more confidence in the management. So a little bit undervalued, no one talked about it, not getting a lot of publicity, and you know there's a solid core franchise there. So if a company at some stage can improve, and you've got confidence that management can actually take it forward.
And was part of it that you thought, well, the Australian economy is weak. As it gets stronger, a company like that's a classic cyclical company. As the economy gets stronger, its share price will sneak up. Probably not to $9, but it'll go up.
Well, that's one of the reasons why you have so-called growth stocks. Sometimes things grow because of what management is doing, and that's, I suppose, the classic growth stock. But sometimes companies can grow a lot more rapidly because the economic circumstance, the external environment becomes favourable, and I think that was what I was looking for in the case of Toll.
Okay, so
I didn't see a lot of downside risk in it. So it was sort of, sometimes you put companies in portfolios because you say there's not much downside risk, so the chances are someone else will see that about them as well.
And it was a solid brand. It was a solid brand, and it didn't have real competitors in the market.
Didn't have a lot of competitors, and it had a very strong both domestic and franchise throughout Asia.
Okay, what are you seeing in reporting season so far that's going to influence the way you're going to invest for the rest of the year.
I agree with Martin. I'm actually a little bit underwhelmed by reporting season, and I'm saying that because it's not as though that the statistics don't suggest the companies are meeting expectations.
The revenue's not bad, isn't it?
The revenues are okay, but remember our market has gone up 11% this year, so we've gone from sort of a band between, largely range bound between 5,200 and 5,500. Suddenly we're over 5,920 today. Yeah. Who knows whether we're going to crack 6,000 or we've got to come back first. We both hope so. But, we've put on, 11%. Now, I would have hoped that the earnings season may have given that a little more momentum. In other words, the earnings would have been a little bit better than expected. Everyone knew the resource companies were going to do it pretty hard.
Yeah, of course. Yeah.
Yep,
and the services company too, the mining sector.
And the mining services would also do it hard. The others, they're okay, but there's not really a lot shooting the lights out.
What about revenue and outlook statements? Were some of those a little bit better than expected?
Well, I actually probably would take one take I'd say is that the oil companies' outlook statements have been a lot more promising.
Yeah, haven't they?
And I went into the earnings season expecting that, look, we knew Santos and Woodside would do it pretty hard. Who cared about what happened last year as far as their result was concerned? I've been more interested about what their forward statements. Now, they're not obviously bold enough to put any numbers in terms of revenues and profits for next year because there's a variable, the oil price, they cannot control.
That's right.
But they've put obviously fairly strong statements around, about their production and all those sort of things. But if you read between the lines, they actually seem to be a little more. It's a bit more positive than I expected. Yeah. So I think if you're sort of thinking the oil price might be around stabilising, there might be some value in some of our oil companies. It's interesting that Woodside.
A company that I was pushing a few weeks ago and used to forget it, baby, but go on.
Well, Woodside is paying, its dividend for the last 12 months is 255 US cents. It's about almost $3.
Yeah.
It's actually going to yield shareholders over 9% for the last 12 months. Now, next year, the analysts are looking for revenue or for profit to fall by about a third, to be about a third lower, and for the dividend to drop from about 255 cents into about 110 US cents.
What kind of yield is that?
Well, that will take it down to about a 3.5% yield. But the question is, there's so much of that number is built around the oil price. And the question is whether, if you're starting to feel it might just be bottoming a little bit, I can't see a lot of negativity in what the companies are actually telling you. They're not, didn't seem a very negative tone in their reports. Maybe some of these, the Santoses and the Woodside are, look, maybe it's nibble-type territory to think about increasing that exposure again to some of the energy companies.
Yeah, okay. And what about mergers and acquisitions? It was pretty big last year because Japan Post and Toll was a huge one. Do you think there's going to be more merger and acquisitions as the dollar falls, Paul?
Well, I think that was the big lesson for investors who'd forgotten about that. Most acquisitions are going to be by offshore companies. When the Aussie dollar falls, it hasn't fallen as much against the yen and the euro, but certainly against the US dollar. A lot of our sort of beaten up service and industrial companies that have got good franchises or a good underlying business or could be a platform to expansion in Asia are going to start to look very cheap. Yeah. So you've got to say that from an M&A point of view, from sort of, bids from offshore, some of our oil companies, some of our industrial companies, some of our service companies, we might see a couple more on the horizon in 2015.
You got any names?
Well, I think you've got to look at the market action. The market obviously pushed transport stocks. Cardno, which has had it really tough as an engineering service company in Brisbane. Yep. Its share price is up something more like over 15% since the Toll acquisition.
But it fell an enormous amount, so the 15% is a nice comeback.
It's just a rebound. There's a few other factors there, but maybe there's a bit of position taking.
That's Cardno? Yep.
Cardno. I think Santos at the right price must look attractive, so you've got to look at what's going on in Santos. I think they're I'd be looking at some of the beaten-up industrial companies, I think, as being where I'd be sort of putting a little bit of thought into.
All right, mate, thanks for joining us. And, of course, if you want to read Paul, he's in the Switzer Super Report. He's one of the star writers there, and his portfolios have done very, very well. Coming up, we'll talk to the CEO of Nearmap. And his company is charting, well, I guess the important question is it charting in the right direction?